So before I explain how life insurance and annuity products are such great retirement planning tools and how I, in particular, can help you get the maximum value from these products, it's important that I first explain the downsides with the alternatives you're probably looking at the moment. So high net worth individuals like you who are looking to save for retirement are usually stuck between two really bad options. The first is a financial advisor who wants to charge you 1% a year on your assets for the rest of your life. What's even worse about this is if you look into the fine details, it's actually a lot higher than 1%. The true cost, all-in cost of an advisor has been shown to be 1.65%, and that's what you'd be paying every year for the rest of your life. The second option that you have is an insurance agent who's really trying to sell you an insurance or annuity product and is incentivized to sell you a product with a high commission that is not in your best interests. So if you're trying to decide between these two options, you're really in a tough predicament. But the way I'd like you to get to think about this predicament is to think about it like this. Let's say you want to buy a house and you have the choice between two agents. The first agent wants to charge you 1% on the value of the house for as long as you live in the house. Let's call this agent advisor. The second agent is going to charge you 6% of the value of the house, but he's only going to collect it all up front, and then you never have to pay him again. Let's call this agent salesman. Well, which agent should you go with? We're going to evaluate this decision-making process on three criteria. The first is cost. The second is alignment of interest. And the third is value. So now let's start with the first criteria, which is cost. Well, this really should be an easy one because the answer really just depends on how long you're going to stay in the house. Because if you're going to stay in the house for less than 6 years, then it's really the best option to go with the first advisor who's only charging you 1% a year for as long as you stay in the house. However, if you're going to stay in the house for longer than 6 years, then it doesn't really make sense to pay an agent 1% every year. Let's just do a quick math example. Let's assume that you're going to stay in the house for 30 years. Well, if you went with the agent who was charging 1% a year for every year that you were in the house, well, you would end up paying 30% of the original value of the price that you spent on the house. However, if you went with the salesman who was charging 6% of the value of the house, but only doing it one time, you would only pay about 6% of the original price of the house. So from the perspective of cost in this example, the salesman wins, or the second real estate agent, because you're paying just a one-time commission and staying in the house for a long period of time. So the next criteria we'll evaluate is alignment of interest. Well, this one should also be an easy one, because if you're trying to buy a house that you're going to stay in for the longest time possible, then you're better going off with an agent who charges you 1% a year for as long as you stay in the house. And the reason for this is that agent is incentivized for you to stay in that house as long as possible, simply because the longer you stay in that house, the more compensation he gets. Remember that he's earning 1% a year for every year that you're in that house. So he wants to make sure that you find a house that you're going to stay in for a very long time. On the opposite side, the agent who's only earning a one-time upfront commission doesn't really have a vested interest in you finding the house that's perfect for you. From his perspective, he wants you to buy the most expensive house possible so that he can earn the largest commission possible. So on alignment of interest, the agent who's really charging you 1% a year has the most vested interest, at least from a direct monetary compensation standpoint, from you staying in the house as long as possible. Now, obviously, if you buy a house that's not a good fit, that's a bad reputation for both parties. But from a purely monetary, direct, upfront, initial monetary perspective, the agent who's charging you 1% a year wants you to find a house that you're going to stay in for as long as possible. So on this criteria, of alignment of interest, the agent who's charging you 1% wins. Now let's talk about value. After you buy the house, what is either agent really doing for you? Well, the answer is not much. The agent who is earning 1% a year, of course, is monetarily incentivized for you to stay in that house as long as possible. So he or she is probably going to send you a fancy report every year about the house and how much it's appreciated, and maybe make some referrals to handy people who can help you make some construction changes around the house in hopes that you keep on paying him or her that 1% fee. But the reality is that there's really not a whole lot of value from that report or those referrals, because after all, you can find that same information more on Google or Yelp. And you're gonna get even less value from the agent who already earned his or her payout up front. Because unless you're looking to buy another house, there's no real monetary incentive for that agent or salesman to help you with your current house. So in terms of value, when you're trying to decide between the two, it's really kind of a tie, because you're not getting a whole lot of value from either of them after the sale of the house, right? But if you were to focus on value, what you would want is an agent who's going to charge you an upfront commission, but is going to help you find a house that you're going to stay in for 30 years. And this is exactly how you should be thinking about the advisor that helps you with your retirement goal. Because the truth of the matter is that you're going to be retired for 20 or 30 years. So who is the person and what are the qualities of that person that can help you find the best solution for you that's going to be that best fit for the next 20 or 30 years? Someone charging you 1% a year for the rest of your retirement just isn't cost effective, especially when the all-in cost is really 1.65% a year. And on the opposite side, someone earning a large upfront commission doesn't always have your best interest at heart. This is the basic problem between the financial advisor and the insurance salesman dilemma. Because life insurance and annuity products offer the best retirement solutions possible, particularly for those in high tax brackets. But the problem is that the people selling you those insurance products are not incentivized to sell you the one that is the best fit for you. They are incentivized, monetarily at least, to sell you the one that makes them the highest commission up front. So more likely than not, if an insurance agent is telling you to buy an insurance or an annuity product, he or she is likely trying to get you to buy the one that pays him or her the highest commission, which of course is not always in your best interest. Sometimes it is, as we'll show in later videos, but for the most part, it's not. If I'm working for you, then it's my job to use my life insurance, annuity, wealth management, and estate planning expertise to ensure that you get the best deal possible, simply so that you can benefit from all the tax, investing, estate planning, and longevity benefits that these products provide. So if you're planning for retirement, are in a high tax bracket, and want us to help you, provide you with a solution that gives you and your family higher after-tax income for you to spend in retirement, or higher after-tax wealth for you to pass on to your beneficiaries, then reach out to us via the link below and book a free intro call.